Hello viewers, welcome to my channel. I'm Hasham Ali Khan. Now I'm going to start a new subject, Accounting for Management, AFM. This is the subject for MBA students. I got many requests from my students to start this subject of Accounting for Management. Already for MBA, I have uploaded the videos for Financial Management, Investment Management and Statistics for Management. After that, I'm going to start the subject Accounting for Management. So in this subject, totally 5 units. The first unit is regarding what is accounting. What is the meaning, what is the definition, what is the scope of accounting, what are the objectives of accounting, what are accounting concepts and conventions, what is double entry system, what is accounting equation, journal entries, ledger accounts, then preparation of trial balance. All these things I'm going to cover up in first unit. Unit number 2, making the financial statements. Every business organization will make the profit and loss account and balance sheet to find out during a year the business has earned profit or incurred loss, and at the end of the year what is the financial position of the business. All these things I'm going to cover up in second unit. There, the financial statements of sole trading concern and also the financial statements of a company. That means provisions of Companies Act will apply. How to make the financial statements. Then unit number 3, financial statement analysis, ratio analysis and common size statement analysis. This is unit number 3. Unit number 4, cash flow statement. How to make the cash flow statement, what are the advantages of making the cash flow statement. This is unit number 4. And last unit, unit number 5, CVP analysis, cost, volume, profit analysis, and how this CVP analysis will be helpful to the management to take the decisions. These are the 5 units I am going to cover up in this subject of Accounting for Management, AFM. So if you want the complete knowledge, watch every video till the end. Don't join in between or skip from the middle. You will not get the perfect knowledge. So I'm explaining each and every concept in detail. So don't think that only solving the problem you will pass the examination. Doesn't matter. So passing the examination is secondary. The primary is you must have the knowledge. You must have the complete command on the subject, on the concepts. Then only you can be able to face the world. Only simply having the degree, having the required percentage of marks, grades, that doesn't matter. Nowadays, the market is very competitive. Until and unless you have perfect, full knowledge, you cannot be able to face the challenges. That's why my request, watch the video till the end. Now, first of all, I'm going to start with unit number 3. So in this unit, the topics to be covered are what are financial statements, what is financial statement analysis, what is the importance and need of financial statement analysis, and what is the ratio analysis, and what is common size statement analysis. These are the topics I'm going to continue in the coming videos on these topics. So before explaining in detail what are financial statements and what are financial statement analysis, take the screenshot of the points which I have written on the board. Then I'll explain in detail. So first of all, the contents of this unit number 3 are financial statement analysis, need and importance. What is the meaning of the term financial statement analysis, why it is needed, what is the importance. Secondly, ratio analysis. There are many techniques of financial statement analysis like comparative statement, common size statement, trend analysis, ratio analysis, funds flow analysis, cash flow analysis. So many analyzing techniques are there. So one of the important technique of analyzing the financial statement is ratio analysis. So in this unit, I am going to explain What is ratio analysis, rationale and utility of ratio analysis? Why ratio analysis is applied? Classification of ratios, then calculation and interpretation of liquidity ratio. All the ratios are divided into 4 categories: liquidity ratio, activity ratio, profitability ratio, and solvency ratio. So for each type of ratio, what is the formula and how to give the interpretation of those ratios? So calculation and interpretation of liquidity ratio, activity ratio, profitability ratio, and leverage or solvency ratio. Lastly, advantages and disadvantages of ratio analysis and common size statement analysis. The first 2-3 videos I am going to explain you the concept of all these things. Then only we'll go for problems. Otherwise, you can remember the problem, simply remember the formula, substitute the values, you'll get the answer. But you cannot be able to give the interpretation. So that's why I'm giving the complete explanation in detail. Watch the video till the end. Now, financial statements. What do you mean by financial statements? Financial statements are the end product of accounting. That means every day the transactions are recorded, then posted into ledger account. This process will be continued throughout the year. At the end of the year, all the accounts will be closed. The accounts will be closed to find out what is the profitability of the business and what is the financial position of the business. So to find out the result of operations and to find out the financial position, financial statements are prepared. The financial statements include a set of reports, schedules, or notes. At the end of the year, a number of reports are prepared, schedules are prepared, notes are prepared that an accountant prepares at the end of the period of time for a business enterprise. So every year, at the end of the year, reports, schedules, notes will be prepared by the accountant for every business organization. Financial statements are the end product of accounting. The accounting will begin with passing the entries in the journal, in the books of original entry. And the end of accounting is preparing the financial statements. So every year, at the end of every year, every business organization will prepare financial statements. That shows the result of operations. Whole year, during the whole year, so many transactions have taken place. What is the result of those transactions? Whether there is a profit or loss. Similarly, what is the financial position of the business on the last date? Financial position means what is the worth of the business, how much the business owns and how much the business owes. This can be known by preparing financial statements. So financial statement consists of balance sheet. It is also called statement of financial position. Then a statement of profit and loss. This is also called income statement. A statement of profit and loss or income statement. This is called balance sheet, or we can call it as statement of financial position. Then cash flow statement or a statement of changes in equity or all explanatory or notes to any of the above. If any schedules are prepared, notes are prepared for all these, that will also be called as financial statements. Now, apart from above statements, the board of directors, BOD stands for board of directors, may prepare additional statements. See here, there is no exhaustive list of financial statements. All the reports, schedules, notes which are prepared by the company and board of directors, that will come under financial statements. So, and they provide additional information to shareholders so that they can present a true and fair view of the company. The purpose of the accounts is to find out whether the company's accounts show true and fair view. So these financial statements are prepared for different users. So many users will take the decision on the basis of these financial statements. So financial statements should show a true and fair view of the state of affairs of the business. Now, what are financial statement analysis? First, we have discussed the meaning of the term financial statements. These are the end products of accounting which are prepared at the end of the year by every business organization to find out the result of operations and the financial position. Now, what is financial statement analysis? Analysis is a process of critically examining the accounting information given in the financial statements. That means, preparing the financial statements is not the end of the matter. After making financial statements, it has to be critically analyzed by making relationship, by studying the figures given in the financial statements. A financial statements will have so many figures. Like in income statement, we have revenue, sales revenue, we have cost of sales, we have expenses. All these are the figures in profit and loss statement. Similarly, in the balance sheet, we have so many figures like current assets, fixed assets, liabilities, current liability. All these are the contents of financial statements. So, we are critically examining and making a relationship in the figures of financial statement. That process of making the relationship in the figures of financial statement is called financial statement analysis. Now, individual items are studied and the interrelationship and other figures are established. A single figure may not convey much meaning until and unless one figure is compared with another figure. One figure is related with another figure. Example, if I say my business earns 5 lakh rupees profit, doesn't make any sense. If I say I'm getting 5 lakh rupees of profit on 25 lakh rupees of investment, that means it makes some sense. That means after making 25 lakh rupees of investment, I am getting 5 lakh rupees of profit. We are making a relationship. So this financial statement analysis says making a relationship between different figures in the financial statements. Why we make the relationship? So that this information can be used for taking decisions. Financial statements will be used by so many parties. They have to take the decisions. On the basis of financial statement, directly we cannot make the decision. We have to analyze. We have to critically examine the figures of financial statements. Now, financial statement analysis is a systematic process wherein information provided in the financial statement is carefully evaluated. Remember, it's a process. Financial statement analysis is a process of critically examining all the figures in the financial statements and making a relationship among those figures to evaluate the performance and financial position of the organization. So mainly, the purpose of financial statement analysis is to extract the information, to evaluate the performance of the business, to find out the financial position of the business. The financial statement analysis is largely a study of relationship among the various financial factors in a business and disclosed by a single set of statements and a study of trend. Not only we have to study only for a particular year, we have to make the analysis for a period of years to find out the trend. So this is called financial statement analysis. Now, what is the need? What is the importance of this financial statement? Why it is important? Now I am going to explain you. The significance of financial statement lies not in their preparation but in their analysis and interpretation. See here, making the financial statements is not the end of the matter. After making the financial statements, it is needed to analyze and interpret. We need information. We don't require only figures in the financial statement. We want the information, so we have to analyze it. We have to make the relationship. Now, this involves a study of relationship among various financial factors and ability to judge their meaning and significance. So, after making the relationship, we can be able to give the interpretation. Making the relationship, we can be able to give the conclusion. Now, need for financial statement. Why it is needed? Financial statement analysis is needed in order to ascertain whether organization has accomplished its main objective of maximizing profit. The existence of every organization is with an objective. So normally a business organization's objective is to maximize the profit. So by making this financial statement analysis, we can be able to ascertain whether our objective is being achieved or not. What is the profitability rate of the business? Are we achieving the target or not? So with the help of financial statement analysis, we can be able to ascertain whether our objective is achieved or not. Secondly, it is required for ascertaining the ability of an organization to pay interest and loans. Nowadays, every business organization will procure the funds from different sources like banks, creditors for loans. So many people are there who supply the funds to the business, and it is the responsibility of the business to repay the loan along with interest. Example, a business has taken a loan from bank. The bank wants to see the ability of the business. Can the business be able to repay the loan along with interest or not? If the bank see that the business is having the ability, the banker will come forward to give the loan. So again, financial statement analysis is a must. Without that, banker cannot be able to take the decision. Third, it is required to compare current year statement in the previous year statement to find out the progress of the business. See here, comparison is must in everyone's life, even for the business. A business organization wants to compare its present performance with the past performance. So for comparing the past performance, again we need the analysis technique. Without financial analysis technique, we cannot be able to compare. One analyzing technique is the comparative statement analysis, where we compare 1 year data with another year data to find out the trend, whether our business is progressing or deteriorating. Fourth one, it is required to compare the operations and profitability of one organization with another one. Two types of comparison are there: inter-firm and intra-firm. Intra-firm means within the same firm, 1 year data is compared with another year data. And inter-firm comparison, we are comparing the performance of one company with another company. So many competitors are there. So every business wants to compare their own performance with competitors' business. Again, financial statement analysis is required for making comparison. It is needed to evaluate the performance of the business. Whether during the current year, what is the performance? How much profitability has increased? Then lastly, it is required to trace underperformance area of an organization. The company's weakness and strength that can be obtained by using this financial statement analysis. So these are few cases which shows the need of financial statement analysis. Now, importance. What is the importance? Many points are there, only few points I've selected. Assessment of past performance. Every business organization wants to evaluate the historical data, past performance. Whether during the last few years our business is growing or not. What is the trend of growth of our business, or whether the business is deteriorating. So for assessing the past performance, the financial statement analysis will be used. Similarly, assessment of current position. Not only evaluating or assessing the past performance, but also current situation. Presently, how the things are going on. What is the performance of various activities of the business. Financial statement analysis will be used. Then assessment of earning capacity and future growth. What is the present ability to earn? How much is the profitability and what is the growth rate? At what rate our business is growing? Next one is assessment of solvency. Solvency means ability of the business to repay the debts. To repay the debts, ability of the business is called solvency. A business is said to have a good solvency when it is in a position to pay all the debts on time with interest. A business is said to have a bad solvency when it is finding it difficult to pay the debts. So in order to find out whether the business is having good solvency or not, financial statement analysis. Next one, predicting the bankruptcy and failure. See, a business will not collapse suddenly. Slowly and steadily it will sink. It will become bankrupt. That means insolvent. So this financial statement analysis will help the management in finding out whether our business is going to become bankrupt or going to become insolvent only with the help of using financial statement analysis. Assessment of managerial efficiency. Managerial efficiency, because ultimately the success or failure of the business depends on the efficiency of the management. So managerial efficiency can be evaluated by using this financial statement analysis. Inter-firm comparison, comparing one firm's business with another firm's business, financial statement analysis will be used. Lastly, decision making. Financial statement analysis will generate a lot of information, and this information can be used by the management for taking prudent, timely decisions. So this shows the importance of financial statement analysis. So okay students, in this video I have explained you about what do you mean by financial statements, what is financial statement analysis, what is the need and importance of financial statement analysis. In the next video, I'll continue the topic of this financial statement analysis and more particularly ratio analysis.